Welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York headquarters. You're watching our brand new show aimed at giving you, the viewers, the ultimate investing playbook. We're going to help you tune out the noise and make the right moves for your money.
From today's top stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we're going to dig deeper into everything you need to know for the last hour of trading.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We look at this sort of concentrated market. It's been great. It's pushed everything higher. That being said, we think the Mag 7 is going to become the Lag 7 as they're going to end up consolidating in here. We're going to start to see a broadening out of this market.
We're excited to see inflation starts to normalize. We think that's a good thing for the consumer. Within our business, I think we see some signs of that rebalancing of the consumer spending portfolio with the improvement we saw in our discretionary categories in Q4.
We're going to start seeing Bitcoin allocations pop up in all sorts of, financial advisors model portfolios, as they make plans. Now, all of a sudden, Bitcoin is an easy asset class for them to, to put into these portfolios.
We'll be covering those top stories and more with just 1 hour to go until the market closes. As always, Julie and I are getting up to you on the market action. A look at the major indexes, Julie.
Yeah, let's take a look at the major indexes, shall we? We've got the big sell-off happening today in tech, with the Nasdaq on track for its worst day since January 31st, and the Magnificent Seven, it's true of them as well. Basically just giving up some of the recent gains. There has been a debate sort of brewing on Wall Street about whether we are approaching a bubble that's fueled by all the AI enthusiasm, although the bulk of the folks that we have talked to have said, no, we are not there yet if you look at relative valuations. All of that said, the Nasdaq today off by 2%, the S&P off by 1.3%, and the Dow off 1.25%. The other place where we're seeing the enthusiasm come off the boil is in Bitcoin, which of course earlier today touched a record high, and now it is coming back down for the moment, back down below 62,000. In fact, doesn't look like there was any particular catalyst that is driving Bitcoin prices lower, but at one point today it might still be on track for its worst session going back to November 9th of 2022. So we haven't seen a sell-off like this in Bitcoin in quite some while, Josh.
Yeah, in terms of names I'm watching, Julie, I think we have to go with Target here, and that stock is absolutely ripping higher in today's trade. That company, of course, reported and pleased investors. Going through the numbers here, Q4 profit, that was better than expected. Another very important metric to watch, though, traffic. Yes, store digital traffic was down about 2%, but the key here is that was an improvement. It's moving in the right direction. It is better than the 4% drop we saw in the third quarter. When does Target get back to growth mode? Target COO telling Yahoo Finance today that the company does expect a return to growth in Q2, Julie.
And that return to growth, by the way, is going to be driven this year, the company says, by opening new stores, by making bigger stores, and by revamping existing stores. And this is something that we have heard from Target in the past when it was trying to come back at other various periods, and it seemed to be relatively successful. The market seems to believe it's going to be successful again this time, but we'll have to see how it works out. They also rolled out that new paid membership, $49 a year, right, for things like free shipping. So we'll see if that takes hold, because it doesn't include content like, say, an Amazon Prime membership does.
Yeah, with this move, we're now about 20% year to date, though. Over the past 12 months, we know there's been some bumps along the road. You're basically flat, but a nice move in today's trade if you're long. Shares of Tesla down again today, meanwhile, fueled by negative headlines coming out of China and Germany. Yahoo Finance's Praz Subramanian joins us now for the very latest. Praz.
Yeah, Tesla shares bouncing around here. They were rebounding a little bit, but now still at their lowest low since, I think, May 2022. 2 days in a row now of sliding here. Latest news is arson attack on the Giga Berlin plant. A left-wing group has sort of accepted or kind of admitted that they had caused a fire at a substation there that knocked out power to the plant. Tesla says that the plant has been evacuated. Power has been shut off. We don't know how many days it'll be shut off for. So this could be a multi-day effect. That plant makes around 6,000 units a day. So could be a significant kind of problem for them from a production point of view. And this follows yesterday's news of the China shipments being lower. So more concern there for Tesla investors and analysts.
Yeah, and that's sort of the point, right, is that it just sort of keeps piling on when it comes to the pullback that we've seen in Tesla shares. We've been talking about the fracturing of the Magnificent Seven, right? That it's not really 7 that are outperforming anymore. But Tesla has been the one that has pulled back the most and sort of the earliest compared with the others.
I mean, so far, down 27%, if not more, a little bit more for Q1. So that's a significant drawdown for a company. I mean, we're talking billions upon billions of dollars. In the Mag 7, what are we down to? Mag 5 now? Is that sort of the play now? Because
or Mag 1, if you're just talking about NVIDIA, which is down today, but was the only one that was up yesterday.
Yeah, so I think that you saw Goldman also today knocking down their estimates for 2024 and 2025 because of the fact that they see price cuts continuing and margin compression also continuing. It's hard to see a bull case over the next couple of months, if not the next 2 years, given where we are in the EV sort of landscape, both here and also globally.
It's so bad that Musk isn't even the richest man on the planet anymore. You see
I know.
that?
Bezos.
Jeff Bezos.
Yeah.
That's how tough it is, Julie.
That's how tough it
Yeah,
is.
It is. Rough times.
Rough times. Thanks so much, Prash. Appreciate it. Well, Tesla's not the only Magnificent Seven stock that is seeing losses as of late, leaving investors wondering how long the group can keep the market rally alive. For more, let's welcome in Nancy Tengler, Laffer Tengler Investments CEO and CIO. Good to see you, Nancy. Thanks for coming in.
Thanks for having me, Julie.
Listen, I want to start with Tesla specifically, right? Because Proust was just saying for many it's hard to see the bull case right now. I believe that you just visited a Tesla facility, if I'm not mistaken. So let's just jump right in there. Do you see the bull case for Tesla?
Yeah, it all depends on what your time horizon is. I'm not investing for the next 3 weeks. I'm investing for the next 3 years. And if you look at the mega battery segment of the business, these are utility grade battery storage
And that's what
units.
you visited.
That's what I visited. And what you'll see is that it's the fastest growing, most profitable business and will probably ultimately, in the not too distant future, dwarf the EV business. So the stock's going to trade on the EV headlines for now. Which gives people like me an opportunity to step in and pick off shares at more attractive levels. We initiated last January at about $104, barely got to buy any and took off. And so now we're happy to go back in and add to holdings for the next 3-5 years.
Nancy, a broader question for you. I thought it was interesting that you say the environment we kind of find ourselves right now in reminds you of the 1990s. How come, Nancy? Walk me through that. What are the comparisons?
I bet you were born in the 1990s.
Oh, man, no. I wish it were so, Nancy. I wish it were so.
Well, I was managing money then, and what you had was an environment where investors had to contend with higher interest rates. So the 10-year was at 5 to 7% on average for the entire decade, 3% inflation growth on average, labor shortage, spending on technology to improve productivity, an inverted yield curve, as well as a soft landing that was executed by Fed Chairman Greenspan. And I think you have to take that playbook out for the Fed this time around. They cut a few times. They raised aggressively in 94, then they cut, and rates stayed a little higher for longer, and stocks roared, and it was driven by productivity. And there's some other differences, but in general, it was also that the US was the best economy on the block, the global block, and we are once again. So I think there's a lot of things to like. We need a correction, so if this continues, I'm not alarmed by that. We get about a 10% correction every 12 months. So we've run pretty hard, pretty fast. So I'll be using it, as I say always to my team, volatility is a friend of the long-term investor. So we'll be using volatility to add to names.
What do you think will happen with volatility if the Fed, like Raphael Bostic floated, cuts and then pauses, or cuts later than expected, or, as Torsten Slok of Apollo has posited, doesn't cut at all this year?
Honestly, Julie, I don't think it matters, because that's the analogy of the 90s. We had higher, the 10-year was at 5 to 7. We're at 4 1/4 right now, and they started cutting, and then they stopped.
And of course, that was also a time where we did not get the communication from the Fed either about what they were going to be doing.
I long for those days.
Really, you liked it better when we didn't know?
I do. I just can't get them to stop talking until we get to the quiet period. But so I think you have to be careful. I mean, valuations are not nearly as stretched as they were then, not even close. I mean, the four horsemen at the end of the decade, Cisco was trading above 100 times peak earnings, and the reason the earnings dropped was because the companies they were supplying to were these internet companies that were being valued on eyeballs, and they went out of business. But we've got robust companies that are generating not peak earnings, and you can just use Microsoft as an example. It was trading at 51 times at the end of the 90s. It's trading at 32 times, and it's a much better company in terms of breadth and depth.
Beyond Microsoft, Nancy, I know one kind of thesis of yours is you say you're looking for, you and your team are looking for those kind of, I think, older economy names, embracing, though, digital solutions, embracing Gen AI. What are some of the names that you think fit that bill?
Well, so Walmart's a perfect example. Target's earnings, we own it, great. But Walmart's an example of a company that has pivoted not just to digitization and e-commerce, but robotics and generative AI to improve productivity, margins. American Express is using AI to reduce fraud alerts. Emerson is generating automation for industrial clients. So as we added to technology in the fall of 2022, people thought we were nuts and consumer discretionary. We trimmed them last summer. They sold off. We added more. This on October 31st, I wrote a piece and we were adding to them. Now we're trimming them again and we're broadening out to financial names. We've increased our exposure to American Express. Industrials, we like a number of the names in the group, but we just added to L3 Harris and Emerson. And then in retail, we do like Walmart, but we've had to trim Chipotle, Costco, Lulu, and Uber, and Spotify. And that's part of the broadening out that you're seeing in the market. These stocks have done better.
Broadening.
It is a stealth broadening. It is. That's
I stole that
perfect,
from you, Nancy. I heard you say it. That's where I got it from. Yeah. Give you full credit.
Aren't you clever?
You're the clever one. He just stole it.
I'm just copying.
What's the biggest risk to this market then? Because you sound pretty darn positive, all things considered.
For the long term, I am. I think the risk is that there's no catalyst right now. So everybody's going to be hanging on every word from the Fed. Every inflation data point is going to get scrutiny. But the fact remains that inflation has come down dramatically. There are sticky segments. I give you that, and I'm worried about that. But now you've got China exporting deflation to the rest of the world. And I think that's going to put some pressure on inflation that will give the Fed some room to at least do 1 or 2 cuts this year, if not 3.
I want to totally switch gears, Nancy, get you out of here on this. I want your opinion on gold and just what you're seeing there, what you make of the trends. Climbed to an all-time high. What do you think is driving that, Nancy? One, like Fed pivot, geopolitical risk, and also, just as a professional, I'm curious, when you talk to your clients, what's the role you think gold has in somebody's portfolio?
So we don't own gold for our clients because we can't custody the actual metal, and the ETFs can be a little bit squirrely. We do have a clean energy infrastructure strategy that invests in commodities. So we own some gold there. And I think there's a couple of things. I mean, I think we're seeing a ton of rotation in this market. Some of it's short-lived. We got the run in value stocks at the end of last year, and then they just had a run the last 2 days. So I think there's just pivoting and trying to figure out where is this market going. But geopolitical risk, to be sure, is on the table, and that could really accelerate, as we know. But it hasn't seemed to derailed the story in terms of the U.S. economy and U.S. earnings growth. So we have a small exposure for our clients, but it's not a focus for us. I think what I've learned over the last 40 years is that the gold trade is cyclical, and what I want to do for my clients is generate long-term sustainable performance. So we don't trade commodities like a lot of firms do.
All right, Nancy, it is always great to have you on the show. Thank you so much for coming.
Thanks, Josh. Thanks, Julie.
We move on. Bitcoin is sliding after briefly hitting a new record high for the first time since November 2021, passing that 69,000 mark. Here with more is Yahoo Finance's very own Brad Smith. Brad.
Hey, Josh, great to see you. Look, longtime market domination viewer since day one here, and I'm ready to dominate this Bitcoin hit for you. First and foremost, we got to talk about Bitcoin down right now. 11%, having the worst day since November 2022. Our own Jared Blickley flagged that for us. And here's where you're seeing some of that intraday activity that took place. Of course, the number that many people should be focused in on, and rightly so, is that new record that we took out from November of 2021. And so the new mark to top and get back above is now $69,191 here. And so we're going to continue to watch this closely. But if you're wondering, well, why did the steam come out of the engine here? Well, Bitwise Asset Management CIO Matt Hogan told us the thing that could stop Bitcoin from rallying is if long-term Bitcoin investors decided to sell. The ETF and that market is soaking up more than 100% of the net new supply. So it's only when people who have been holding Bitcoin for 6 months, a year, 2 years, 3 years, they decide to sell, that we could see prices pull back just as we are right now, because he doesn't see the ETF demand going anywhere, Hogan explains. Holding 60,000 could be a key level to hold, with hopes of a new support during the higher highs witnessed as Bitcoin is clearly broken out of this crypto winter here. So here are the keys to the Bitcoin record that we've seen so far and what's yet to come. ETF applications and approvals, the April Bitcoin halving anticipation, plus you've got a year of global elections. So let me break down two, and then we'll have a conversation about the last one. First and foremost, the global crypto market cap. It sat earlier today at $2.42 trillion, according to CoinMarketCap. Dinara co-founder and CEO Lawrence Latimer, he told Yahoo Finance on December 26th, we think by the end of 2025, $2.5 trillion is in view as that overall market cap. So if you kind of average that across the industry, we think there's another potential 50% or so upside built into the pricing of assets. That was in December, Bitcoin being among them. Now, you think about the ETFs and the halving. Ben McMullen, who is the IDX Advisor's chief investment officer, said this morning, I think this time you've got more breadth behind this particular rally, which makes this milestone more significant. Landscape of buyers coming into the market from off the sidelines through these ETFs. This is a lot stronger tailwind than we saw a couple years ago with the all-time highs last time around. So at this point, roughly 95% of all Bitcoin that have already been mined are already in the ecosystem. That's not to say that it's not going to have an impact. It's just, potentially one other thing that could be a catalyst here as we move forward here. So back to Economics 101, that's going to provide a nice little tailwind for further upside pricing here.
Brad, let's also talk about the role that global elections could play. You mentioned there that they could play a role. Dig into that a little bit for us.
Yeah, that's right. And so you do have more than 60 countries heading to the ballot boxes this year in elections around the world. And there will be areas where crypto or Bitcoin most certainly is on the ballot. And we had the opportunity to speak with a few folks about this and legislative actions in which regions could be pivotal about this. And particularly here, we did get one comment from the Chainlink co-founder as well, who said, I think the Asian markets, especially Hong Kong, Singapore, will be at the forefront of Bitcoin and digital currency adoption this year. This is mainly because the regulators in those regions have more progressive and open-minded views towards digital assets and seem committed to making the region a leading jurisdiction from them. Also went on to believe that in the Middle East, that's going to drive the next wave of adoption following Asia. Appreciate Sergey for those comments there. And then we did also have the opportunity to just briefly speak as well with Ben McMullen on that matter. And it's really just coming back to the number of people that are going to potentially look at this as an inflationary hedge and perhaps vote in favor of anybody who's running a campaign that is a little bit more cozying up to crypto here. And that does include the United States as well.
Interesting. The Bitcoin-driven voter. I mean, Anthony Scaramucci told us yesterday that he thinks that another Biden presidency would be better for the crypto industry writ large. We'll see if people believe him at the ballot box, if that's their primary motivation. Brad, thanks so much. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, shares of Apple sliding again today, this time on concerns over iPhone sales in China. Coming up, we're taking a closer look at the downward trend and whether the company can turn things around. Also, Apple leading the declines for tech, and the selling is accelerating heading into the close. The major indices near the lows of the day. We're going to take you through the rest of the final hour of trading. And the action doesn't stop at the closing bell. CrowdStrike is reporting earnings after the close. We'll bring you the results as they cross. All that and more when Market Domination returns. Let's do a quick check of the markets because we are seeing the selling accelerate to some extent here. The Nasdaq, which has been leading declines all day, we've been talking about the climb that we had been seeing in tech, and now this slide. The Nasdaq now down 2.1%, the S&P off 1.4%, the Dow off 1.33% or 515 points. And if you take a look at the Yahoo Finance Interactive here, you see the XLK is in deep red, which indicates that it's down a lot. As you can see, it's off 3.1%. Now, a lot of software in that group, a lot of cybersecurity stocks in that group, and that's where we're seeing a lot of selling today. Then you've got the XLY, which is consumer discretionary, followed by real estate. So it's sort of a mixed bag today in terms of classic defensive and cyclical stocks. The energy and consumer staples groups are the only ones that are in the green in the session. Well, it's time now for call of the day. Let's start with Citi, which is maintaining a buy rating on Novo Nordisk, the big pharma company behind the diabetes and weight loss drug Ozempic. The bank is remaining bullish on the stock. That's even after a clinical trial showed the drug delayed progression of chronic kidney disease in patients, cutting the risk of a major cardiac event and death by 24%. It cut the risk of major cardiac and death by 24%. Most analysts, however, were looking for 30%.
Right.
So the street was actually negative largely on this study. The stock is down. Citi coming out and defending them.
Yeah, it sounds like next steps, the company does plan to reportedly, I guess, file for regulatory approval of a label expansion, I guess, Julie, for Ozempic. That would be here in the States and the EU this year. To your point, some analysts I saw did say perhaps expectations were for an even stronger outcome. Also, you just look at this stock, though, too. I mean, you priced in a lot. It's yes, it's down. It's about 20% this year, 70% over the last 12 months.
Yeah, I mean, the company says it is going to have more details on the study at an industry conference later this year. And so the Citi analysts are looking ahead to that. They also say, the Citi analysts, that this signals Novo's intention to be quite aggressive with expanded indications for this drug, so that there's more possibilities of more patients being prescribed it. Exactly, that there's a lot of different things. On the flip side, I should mention a little bit of a tertiary effect today, or secondary effect, for Fresenius, Baxter, DaVita, all of these companies that make things to help. They make dialysis, they make other things to help kidney patients. They're rising today on relief. Exactly.
Next catalyst call is from Wolfe Research, feeling bullish on AT&T. They upgraded this name to outperform, citing better cash flow, less debt, and greater efficiency. So there was, of course, that embarrassing outage just recently, network outage. We talked about that. But the team at Wolfe Research, they look past that, Julie. They're fans. They raised the rating to outperform. Their target goes to 21. Average price target, looks like on the street, by the way, is around 20. It says fundamentally AT&T is on course, likes what they see in a number of areas, including churn, which he now says is at peer levels.
Yeah, and it's an interesting call here because, for lack of a better word, Wolf's Peter Supino was meh on AT&T for quite a long time.
It's a technical term.
And on telecom more broadly, they say it's time to take AT&T that is, seriously as a long. Among other reasons, they look at as a step function margin improvement. In other words, a significant step up in margins in the consumer wireline business, according to Supino, and also looking at postpaid phone subscriber results, he says, that have weathered competitive pressures. And we know that telecom business is very competitive.
And by the way, Bloomberg, citing his sources, says CEO John Stankey has quietly joined the elite Augusta National Golf Club. So at the Masters next month, Julie, I know you'll be watching, look for Mr. Stankey in that iconic green jacket.
You know I will not be watching. Are you a golf guy? Do you watch golf?
No, I'm not. But if I was, this would be the club.
Sure.
Our final call, Spruce Point warning of a 40 to 60% downside risk on Zillow, the online real estate company, warning that the core business has matured and new growth is facing near and long-term headwinds. Ben Axler is out with the new reports. He's the Spruce Point founder, CIO. He joins us now. Ben, it is good to see you. So you're betting against Zillow here. Ben, you see shares could fall maybe 40, even 60%. How come, Ben? Walk us through the argument, and why make this bet now, Ben?
So we love companies like Zillow. This is not a news story. This is a very mature tech company that's under fundamental pressures and regulatory and litigation risks. So let me explain. Fundamentally, there's a new entrant that has committed $1 billion to market against Zillow, and that's Homes.com, which is owned by CoStar, a company 3 times the size. They rolled out a bunch of Super Bowl ads you may have seen that's not a company you want to bet against. Secondly, what we think people fail to understand is that Zillow's core customers are buy-side real estate agents. So they sell leads to these agents. Now, there was a landmark lawsuit against the National Association of Realtors that lost a lawsuit, which effectively, we believe, is going to unbundle broker commissions between buyer brokers and seller brokers. What that means in practical terms is that ultimately we expect a lot of brokers to leave the industry, commissions to compress, and that the budgets and money available for Zillow's core customers to spend on Zillow is going to go down. So, we have these overarching issues against a company that has failed to hit its targets time and time again, that's overvalued, that has poor governance, and ultimately we think 40 to 60% downside risk.
Ben, I am curious, Josh asked about the timing here. And, the litigation stuff happened late last year. Homes.com has been deploying capital, and the stock went down quite a lot. So the bulls might argue, well, a lot of that negative news is priced into the shares here.
So let's tell you what's new. Zillow just put out their year-end earnings and updated their investor presentation, which they hadn't done in 2 years. And if you look carefully, they retracted their 2025 revenue goals. And by that, they implicitly guided down substantially their 2024 revenues. In addition, Zillow has been telling investors that they're going to get the 45% EBITDA margins. They also said that was by 2025. If you look carefully, they no longer have a time frame, but yet are still sticking to this 45% EBITDA margin target. And what's odd here is that if you look at the market estimates, the analysts, the majority that say buy, they're not even forecasting 25% EBITDA margin. So there's a huge disconnect here that seemingly the analysts don't even trust management's guidance, but yet the stock seemingly has upside to $60 per share. So the timing, if you ask us, if we look at a stock that most recently was trading $57 to $58 a share with very limited upside and a lot of downside if our litigation thesis plays out and our competition thesis plays out.
Ben, I'm just curious, how much of your call here, if at all, is related just to the broader health of the housing market, Ben? Meaning, if the housing market was on stronger footing, would you still be making this call on Zillow?
I think there's a misperception. Zillow isn't as much levered to housing as you may think. So they have this mechanism where they sell leads under a market-based pricing. A lot of the high-quality zip codes that brokers might buy are generally saturated or sold out, and they don't have a lot of pricing levers there. In addition, they've also switched their model a little bit. So they're rolling out this, what they call flex model. And what that means is Zillow will give leads to brokers, okay, and book revenue on that. And then years later, these leads may convert and that broker may close a deal and then pay a commission to Zillow. And this creates some friction between some of their clients that aren't under this model, under this flex model and the other model. So there's some friction there. And there's also a lot of unknowns. Zillow won't even tell you the frequency or the conversion rate of these leads. So we don't think Zillow is necessarily as levered to the housing market as most people think. And as such, that's why you haven't seen the leverage in the margins and also why they've had multiple disasters in the past. I'll just recall they destroyed over $8 billion of value with their iBuying program, which was supposed to use their knowledge and intelligence to buy and sell homes, at a better pricing mechanism than the general market. That failed too. So we really don't think Zillow is levered to housing to the way the market believes it is.
That would have been a good time to short the stock too, perhaps, Ben. And lastly, I'm on that front. I'm just curious what your financial interest is here. Are you in fact short the stock, or is this just sort of a research report that's out there? And what do you have to gain as the stock goes down?
100% fully disclosed, and that's the front page of our disclaimer. We are short the stock. We made our best efforts to do as much high quality, differentiated forensic research as we can. We laid out the facts to the best of our knowledge. Management isn't commenting. We certainly have an open invitation to them to call us and correct us where we're wrong or issue a rebuttal, but we certainly haven't seen that at this point.
We should mention we did reach out to Zillow for comment, but have not heard back. Regardless, Ben, thank you so much for joining the show today. Appreciate it.
Thank you very much for having me.
And coming up, we are looking at how the resilient shopper is faring in today's investor playbook and breaking down what it means for retailers. Stay tuned. More market domination still to come. We're less than 30 minutes away now from the closing bell on Wall Street, and it's a tough day for investors. The Magnificent Seven not looking so magnificent right now, but the question is this just one day of profit taking, or is a deeper pullback looming? Jared Blickery is here with the very latest. Jared.
Josh, that is the question for investors. Everybody wants to know, are we going to see more of this in the days to come? I will attempt to lay out the possibilities, but nobody knows for sure. Picture's worth 1,000 words. You can really see the hit the mega caps and just about everything else is taking in the Nasdaq 100. Microsoft here in the upper left, that's down over 3%. Broadcom and Tesla down 4% over that each. And by the way, Broadcom is now bigger than Tesla in the S&P 500, and Tesla's number 10 worldwide. So here's the sector action today. Only energies and staples in the green. XLK, that is tech, that is having its worst day since December of 2022. That is a long time ago. And so what's going on? Under the hood, we're seeing weakness both in semiconductors. You can even see NVIDIA is down about 40 basis points. Not a lot, but that has been the market leader. And also in software, which is actually worse off than chip stocks today. You can see a lot of these names like Adobe down 4%, Salesforce down 5%, list goes on. But in general, we're seeing a rise in volatility. And here's the VIX over the last 3 months. And what's interesting about this chart, I'm going to put a one-year chart. You can see there's this broadening megaphone pattern. We see this in the VIX sometimes. In fact, we saw this last year. This led to a more pronounced market decline in the S&P 500 in stocks. But I would say the 10-year T-note yield, we are not seeing that much pressure from it. In fact, we're seeing it down 8 basis points today. Also not seeing any pressure from the U.S. dollar index. So I would expect that we're going to just see some more market rotation unless we see the U.S. dollar and interest rates spike. That's when we would see a bigger market correction. Until then, I'm personally not too worried.
All right. Well, we shall see how it unfolds. Thank you, Jared. Appreciate it. With just over 20 minutes left till the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance Playbook. Today, the consumer is front and center after fueling the economy's growth for much of 2023. We're looking at how resilient the shopper is faring and what it means for retailers and beyond. We're joined by Dana Telsey, Telsey Advisory Group founder and CEO, and Michael Lasser, UBS U.S. Hardline and Broadline and Food Retail Analyst. Thanks for being here, both of you. Appreciate it.
Thank you very much.
Thank you. I want to start sort of big picture here for both of you and ask each of you, Dana and Michael, to kind of set the stage for where the consumer is right now and kind of where we are in the retail cycle. And I know that's a big question, but if you can do it sort of succinctly, if you would. Dana, I'll start with you.
Great. I think the consumer's in a good place right now. There's always headwinds and tailwinds, but I think there's more tailwinds. When you think about the strong labor market that's out there, when you think about moderating inflation and the potential for lower interest rates, those are all pluses. You have the headwinds, whether credit card delinquencies, lower tax refunds so far this year than last year, and the geopolitical uncertainty, but spending power of the consumer is stabilizing to improving, and that basically is a benefit.
And Michael?
I look at it a little bit different. I think the consumer is getting fatigued and spending is becoming a bit more episodic. For example, we saw a real slowdown in consumer spending right prior to the holidays. The holidays were strong, especially around key events like Black Friday and Christmas. And then in January and February, the consumer retrenched. So our picture of what's happening with the consumer, while the labor market is stable, some of the excess savings that have been driving disproportionate growth in consumer spending over the last few years has been worked off. So consumer spending is becoming a bit more episodic and volatile in nature.
And Michael, while I have you, I want to get your take on Target. You covered that name. Listen, they reported clearly investors like what they see. What did you make of that report, Michael? And as an analyst who has a buy on that name, what are the catalysts ahead that you think moves this stock higher?
So Target is clearly getting its footing back. Its traffic was less bad this quarter, and that is a foray to seeing an improvement as it gets past this current quarter. Plus, the margins are very strong. And that's not just because they don't have the inventory to discount. The underlying strength in margins are what's really standing out. We think that Target can retrace to historic margin levels within the 6% range. And as the market sees evidence of that, that'll be a catalyst for this stock to move higher. A couple other catalysts, the company's going to be at our UBS Consumer Conference next week, where it's going to be in front of a lot of investors, further outlining reasons why it can maintain its momentum. Plus, as the alternative data starts to look better in April, May, and June, as it laps some of the issues it had last year, that'll be another catalyst. So this is a stock that, yes, it's had a move, but you still are going to retrace to peak margins with catalysts on the horizon.
And Dana, I have a question for you about Target as well, which is that sort of historically, you thought of Target as being targeting a higher end consumer. We've seen other indications that that higher end consumer has held up well, but it hasn't necessarily seemed to benefit Target. Is that because they're not connected any longer, or that they're not attracting that consumer any longer?
I think overall you're still seeing a positive view to when collaborations and in-store shops are at Target, whether it's Kendra Scott that's been successful, whether it's the Ulta that's been successful. But you're looking at the consumer, even at the aspirational level, having moderated their purchases. So whether they're spending at outlets or whether they're spending at off-pricers, there's a lot of choice for brands with a value.
And Michael, another trend, another theme I want to get your take on is this issue of shrink or retail theft. I'm just curious, Michael, across the kind of your coverage universe, how much of an issue is that? Can we quantify that? And also, is it more of an issue for some names, Michael, that you cover than others?
Yeah, so 2 points. First, going back to the previous question, the reason why Target's trends have been under pressure is because it over-indexes into the categories where consumers just less interested right now. Things like home appliances or consumer electronics that is experiencing some give back of the COVID benefit experienced over the last few years. As far as shrink, our belief and strong belief is that this is going to be moving from what was a headwind for a lot of retailers to a tailwind. While there's been a lot made about organized retail crime, that's only been part of the issue. The fact that retail went from having a lot of inventory in 2022 to a lot less inventory in 2023 means that there is just more opportunity for unexplained loss of inventory. And now a lot of the inventory has been cleaned up, and we're going to see shrink being less of an issue in 2024. Who stands to benefit the most? It's Target, that experienced 120 basis point drag from the rise in shrink over the last few years, as well as the dollar stores like Dollar General and Dollar Tree, and then Ulta and Five Below are also in that camp as well.
And so those are some of your picks. Dana, what do you think is the best way to play retail right now?
I think it's about innovation and value. And when you think about innovation, companies like Bath & Body Works, which underperformed last year, is introducing new categories this year with a big loyalty program. I look at it as an opportunity. Ralph Lauren, which continues to get AUR increases, I think that's exciting. When you think about value, think about off-price. TJX that reported last year with big traffic gains, and with the rest of their off-pricers reporting this week. Ross Stores after the close, and Burlington on Thursday morning.
Very quickly, Michael, introduce Costco, another name you cover. They're reporting this week on Thursday. What are you expecting there, Michael?
Costco's already given us its sales reports, so there shouldn't be a lot of surprise there. It's seen an inflection in its discretionary categories, things like appliances and furniture, which shows it's ahead of the curve because other retailers are not experiencing the same thing, at least as of yet. Plus, we expect that its margin has been well managed, especially as inflation has moderated, and Costco's been an effective steward of that. This will be the last conference call where the outgoing CFO, Richard Galani, is going to be participating. He's going to be retiring next week. He's also going to be at the UBS Consumer Conference, where we expect that he'll outline a lot of the opportunity that Costco has moving forward.
Dana, Michael, thank you both so much. Really appreciate your time this afternoon.
Thank you.
Coming up, we're checking in on some of today's top trending tickers, including shares of CrowdStrike sinking ahead of earnings. Stay tuned, more market domination right after this.
Less than 15 minutes away from the closing bell on Wall Street. Let's check in on a few trending tickers. We begin today, Julie, with SoFi, MicroStrategy, and Albemarle. And what do those have in common? That's what you're asking.
Well, I'm not asking. I know
well,
the
I'm
answer.
telling. How about I just telling? Convertible bond sales, which are, by the way, just kind of generally ramping here, which is interesting. Barron's noting in the past 24 hours, 8 new convertible bond deals, totaling more than $5 billion. So let's go through the notable transactions. The largest is Albemarle, $1.75 billion. SoFi comes in next, $750 million, and MicroStrategy's deal is for $600 million.
So you might be asking, or you might not be asking, but viewers might be asking, well, why do these stocks go down when there's a convertible offering? Well, it's because these bonds are convertible into shares at some further point. And when you have more shares, it tends to dilute the value for existing shareholders. There's more supply of shares. So more supply of something, the price tends to go down. So they're falling in sort of anticipation of that. It's also worth mentioning, by the way, what they're using the money for, because it's sort of interesting here. As we know, MicroStrategy is the biggest corporate holder of Bitcoin. So apparently, they plan to pay for some Bitcoin with doing this. They own just under, 200,000, just about 193,000 Bitcoin is what they owned as of February 25th. Albemarle is a lithium company, so they plan on financing some more of their lithium mining operations. And I have to admit, I'm not sure what SoFi is using its money for. Corporate operations, I assume it's in the filing.
By the way, put that number in context. If all the deals apparently in the past 24 hours are priced, U.S. new issuance for 2024 would hit $15 billion, compared with about $10 billion through the first week of March 2023. Just
right.
some
Well,
context
we've seen
there.
record issuance, it makes sense. And let's talk about CrowdStrike as well. Those shares are trending because they are down as the company gears up to report its fourth quarter results after the market closed today. Investors eyeing guidance from the cybersecurity company as artificial intelligence sweeps the tech space. The shares earlier were down even more, now off by about 5%. Now, you could say they're just getting swept up in the downdraft that we're seeing in tech today. Software is down. Other cybersecurity firms like Zscaler are down. Still, perhaps it also reflects a little bit of trepidation over the numbers.
Yeah, I don't see, a hard headline, and so perhaps it's just positioning ahead of the earnings report after the bell. I am, looking forward to this one because this, listen, it's had a big move. It's up about 130% over the past 12 months. Street loves this name. NVIDIA like love, 90% for the buy. Yeah, and it's just interesting what CrowdStrike does too. They kind of protect what are known as endpoints. So that means everything from your apps to servers to laptops. So looking forward to that print.
Yeah, and we're going to break those numbers when they come out and have analyst reaction.
We sure will, from a very smart analyst, by the way. You know my favorite cyber analyst. You realize that?
Yes.
Rob Owens, Piper.
Yeah, all right.
Checking in now on one of the magnificent 7 names. Apple shares are falling on a report from Counterpoint Research showing iPhone sales dropping in China in the first 6 weeks of the year. This follows news from yesterday of a $2 billion EU antitrust fine. Shares of Apple sliding to the lowest level in roughly 4 months. Joining us now to talk all things Apple, Ben Beharin, Creative Strategies and CEO and Principal Analyst. Ben, it is always good to have you on the show. So let's start on that headline today, Ben. So listen, the stock's down today again, and it looks like it's on this headline from Counterpoint Research saying iPhone sales, they plunged, according to their research, 24% in the first 6 weeks of the year. Rival Huawei, they say, going the other way, unit sales actually surged more than 60%. How worried, Ben, if you're reading this, you're an Apple investor, how worried are you, how concerned are you about that headline?
Yeah, I mean, not terribly concerned. I think most investors we talk to take the long view in iPhone sales. I think sort of the quarter-over-quarter fluctuations, people understand that there's still broad softness in China, especially at the high end. I think if you look at some of the sales that's happening there from local brands, even some of the surge from Huawei is not entirely in the high end. And I think most people who look at some of the underlying data know that in China, Apple's retention rates, so loyalty and intent to buy iPhones going forward, remains the highest of any brand. And I think we're just continuing to see some of this delay in the high-end refresh that we've sort of been watching for the last few quarters in China. And on top of that, I think it's becoming, again, abundantly clear that the refresh rates in China, especially in the high end, are elongating. and that's really impacting everyone. But to this point again with Huawei, it doesn't look like they are taking share from Apple. They're recovering from a very small base after the sanctions that were hit on them. So like I said, I think everybody's holding the long view, and within that view, it seems like things will normalize and be relatively stable on par in terms of expectations in China for the year.
I'm just interested to push on that point, though, Ben. China is such a critical market for Tim Cook, but when they last reported December quarter, China sales down 13% year over year. So I guess when do you see that changing, Ben? Is that near, intermediate term?
Yeah, I think there's been optimism that we're starting to see some of that recovery probably from March into the middle of the year, and then obviously it goes soft again right on the heels of new iPhone launches. There's obviously a whole lot of discussion around how much anticipation is there for the next iPhone. I think there's been a huge sort of debate around will iPhone consumers in China wait, even push their upgrade cycle even longer toward the end of the year, hoping that some Gen AI stuff comes for Apple in the next platform launch. So I think there's a little bit of that. I mean, obviously, to your point, which is correct, I think there's been the criticism that the iPhone was just not as big of a year-over-year upgrade enough to really move a cycle. I think, again, I keep coming back to this doesn't mean that sales are gone. It's just that sales are delayed. And so I do think we're seeing some optimism that that's refreshing now. But obviously, I do think there'll be a big spotlight on the fall as Apple integrates AI and what that next iPhone could be in terms of satisfying more of that pent-up demand that we feel is in China.
Ben, it's not, of course, just the China concerns. I mean, the stock is down some 12% this year at a time when a lot of tech stocks have been just roaring higher. What do you think that's about? Is it about a combination of China and lack of AI, pizzazz, for lack of a better word? Or is there something else going on here? And how is Apple going to win those investors back?
Yeah, I think the main one is sort of exactly, kind of what you pointed out, is that there's a relative stability with Apple. I think there's questions just about how much more growth, can they see? If you're evaluating this on a returns basis year over year, there's obviously a bunch of stocks out there that are tied to AI names that are seeing significant returns, especially over the last 6 months. So there's the balance of what do you hold when, when you're doing an evaluation of your portfolio. I do think that there is a lot of hope on what they do in AI, and that will then attach them to some of this lift. It's hard to estimate exactly what that could be, but obviously, you look at a lot of the semiconductor stocks, a lot of the software companies that are middleware for AI, and you're seeing a tremendous amount of valuation there. So there's excitement around that. Apple has benefited from none of that yet, and I think that's the wait and see moment. And the hope is, again, that they can break kind of the cyclicality that we're seeing where they're in a holding pattern of roughly flat sales for the vast majority of their categories. And can AI lift that into a additional growth mechanism as we wait for, Vision Pro and some of these other things to really ramp up and become new categories where significant revenue will come from.
Ben, thank you as always for joining us. Always appreciate it.
Happy to be there anytime.
Taking one last look at the markets before the closing bell. Sharp declines across the board while we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and that means it's market domination overtime. Josh and I, joined by Jared Blickery, to get you up to speed on the action from today's session. Let's see where the major averages ended up here. And I'm starting with the Nasdaq because this was the laggard of the day, actually finishing a little wee bit up off the bottom here. It was down as much as 2.1%, finishing down by about 1.7%. So a little bit of bounce off the bottom. That is true of the other major averages as well, although it's quite a small bounce and still well off on the session here. 1% decline each for the S&P and the Dow Jones Industrial Average. Also wanted to give another check on where we stand with Bitcoin, because that has been in so much focus as of late. As we talked about earlier, hitting a record just around 69,000 here, before then coming down. Not unusual to see volatility in Bitcoin, certainly, and we'll be watching it in the coming days, won't we, Jared? Give us a closer look now at today's sector action.
You know, Julie, it was a bad day in tech and not a lot of other sectors in the green, although you do see energy and consumer staples and financials just barely in the green. But XLK having its worst day in months, if not years. Got to do the final tallies, but pretty ugly price action. And you take a look inside the Nasdaq 100, picture's worth 1,000 words. And guess what? NVIDIA, another record high. So as I was saying in the prior hour, I'm not too worried about the future here. It's not like we're seeing a tremendous profit taking, but we did take a step back today. You see Broadcom and Tesla each down about 4%, and there was some ugly price action. You also take a look at unprofitable tech. This includes some of our innovation components, disruptors, but they are in the same league as semiconductors and software today, which is to say it was an ugly day on the street. Off to you, Josh.
It was ugly on the street, including for Meta shares today. They did end the day lower, sliding after reports of widespread outages across Instagram and Facebook. Of course, Meta has a lot of fans around the world, and some of them did deal with technical issues today. Per reports, more than 500,000 people said they could not access Facebook this morning, and folks had trouble accessing Instagram, WhatsApp, and Threads too. It wasn't just Meta either, by the way. Outages at X, YouTube. By lunchtime, though, Meta did say the issue was resolved for everyone who was impacted. What was the source of the issue? Unclear right now. Of course, the kind of rumor mill was in full swing at one point. Was this an attempt to disrupt Super Tuesday? Biden administration, however, telling Bloomberg it has not seen any specific or credible threats attempting to disrupt presidential primary voting, Julie.
So in the end, we did see Meta shares down about 1.6%, but that seems to have had as much to do with the general tech sell-off, perhaps, as anything linked to this, right? So I think at this point, people are in general used to disruptions when it comes to their social media. So as long as it doesn't last too long,
they roll with it. And by the way, of course, we always keep the I mean, yes, 1.6%. It's up 165% over the past 12 months. So we know that name's been an absolute monster. Yeah. Moving on, despite the sell-off on Wall Street, one retail stock is standing out to the upside, and that would be Target. That stock is jumping on earnings ahead of the open. We have finance executive editor Brian Sozzi is here with his takeaways for the day. Brian.
Yeah, this quarter really hit the bullseye. Make that gong sound or blow out the football whistle. Nonetheless, one of the top three tickers on the Yahoo Finance platform today, up double digits. Not the normal session for a discounter like Target, but really what Target did here hit a lot of really important notes. First, last year, they revealed that they cut $500 million in costs out of their business, really boosted profit margins in a year that sales were absolutely in the tank. Why? People didn't shop the toy aisles or bought a big screen TV. Nonetheless, Target said that. And then on top of that, they held a closely watched New York City Investor Day, said they're going to launch a membership program that takes aim at Amazon Prime and Walmart Plus. $49 a year, I believe, gets you a same-day free delivery, gets lots of analysts on Wall Street, I'm sure, excited they're going to generate millions of dollars in Costco-like membership fee income. I caution people to just think before you start modeling that in, because it doesn't happen overnight. And then lastly, Target also came out and said they will be opening hundreds of stores throughout the next decade, about 30 this year, 30 next year, and they will continue at this pace. That is a number a lot of folks in the street, I don't think, baked in for Target, because they haven't been opening up stores at that pace over the past few years.
And they're going to be bigger stores, as I understand it, too. I mean, this reminds me of, like, what was it, 7-8 years ago, where Target did their last, like, we're making the stores more beautiful, we're re-merchandising, we're refreshing. But, like, it's just interesting. It feels a little bit like you know, we're back to the future here when it comes to Target in that sense.
Yeah, let me toss up my takeaways, because I think there's some broader themes you brought up here, Julie. One, within retail, and we'll get some more retail earnings this week, Nordstrom, some discounters, whatever it is, you'll find on our platform. But a lot of cost cuts. A lot of retailers cut a ton of costs last year from their operating model, and now that is starting to weave through their financial statements and really boost margins. Check done, that's good. Inventory levels for Target down 12% year over year. Inventory levels throughout a lot of retailers are reported, like Walmart down, Lowe's inventory down, Home Depot inventory down. That helps keep costs low. And what you mentioned, store openings, it's not just a Target thing. Home Depot, of all places, opening 12 hulking supercenters this year to sell lumber and plywood to various people. I believe you have the Trex, CEO of Trex coming on.
We do.
I saw him in the green room. I think that is a very good thing for that company as well. Home Depot opening up more stores to sell flooring. Lowe's opening up stores. Walmart opening and remodeling hundreds of stores. These retailers, even if the consumer is under pressure, are finding new ways to unlock growth, and shareholders are simply eating all this stuff up.
Let me ask you this, Brian Stasi. As you sift through these earnings reports, you listen to these calls, you talk to these executives, you're a viewer right now and you're a retail investor. Where do you want to commit capital? Where do you want to play? Do you want to play low-income consumer, high-income consumer?
I'm going to try to confuse everybody. I think you want to try to play the high-income consumer and look through the prism of where are they shopping. They are, in fact, shopping at Walmart. I will just add, before I get flagged by various people, I'm not telling you to go out here and buy Walmart shares. I'm telling you what I heard from Walmart's earnings call just about 2 weeks ago. They are telling you right off the bat, a higher income household is going to Walmart. They no longer view Walmart as a dumpy place to buy home goods. They no longer view Walmart as not a good alternative compared to a Kroger, and they want to give them more of their money. And I think that's how you do it. That's why Walmart shares have outperformed the past year, and they're just really operating very well right now under CEO Doug Milne. I hope I didn't confuse anybody.
No, strong take.
I won't
strong, passionate
take. Remember, I didn't tell you to go out and buy Walmart, so don't flag me on X saying I told you to buy Walmart. This is just analysis, real time.
Where do you shop, Brian Stasi?
I actually, I go to Target. I'm still a Target guy.
I like finding my beyond. Wait, are we?
It's Target.
Are we agreeing?
I really want to try very hard to always disagree with you, because it's just natural and it just makes for better segments. But I have to agree with you. Target, it's just a fun place to shop. They have my Beyond Meat meatballs. They have maybe a T-shirt that I need for $9, and I'm okay with all that. I'll give Target more of my money.
They also, I gotta say, the kids' clothing. I still go there sometimes for the kids' clothing.
Yeah.
Wait, can I ask you a question? I'm going to ask you a question. Are you signing up for the new Target membership program? Do you need that in your life?
No.
Okay, and I think that's very telling. And
I
I think that answer right there, if you're an analyst, you're modeling millions of dollars
after
for Target.
Julie Hyman's shopping
that is the average American shopper right there. Listen to Julie Hyman. She's not signing up for it.
Typing Julie Hyman in spreadsheets all over Wall Street.
I don't know that I'm the typical American shopper, but I appreciate your vote of confidence in modeling.
It's an honor to be here. Thank you.
Thank you. Thanks so much, Saz. Appreciate it. All right, let us get to some breaking earnings news. CrowdStrike is out, and that decline that we saw today has melted away. The shares are up 16.5%. It looks like a beat across the board, both looking backward and forward. Let's look backward first. Fourth quarter adjusted earnings per share, 95 cents. That is 12 cents above what analysts were estimating. Fourth quarter revenue, $845.3 million. That, too, is above what analysts had been anticipating. And the company's forecast, whether you're looking at 2025 earnings per share or first quarter earnings per share, the company is modeling numbers that are above what analysts are anticipating. Revenue, still potentially a little room to miss estimates when it comes to the 2025 revenue forecast. $3.92 billion to $3.99 billion is what CrowdStrike says. Analysts had seen $3.94 billion. So if you take the midpoint of that, maybe there's a little bit of chance for a miss. But overall here, the company's numbers beating estimates. So that trepidation that we saw expressed in the shares today when they fell, well, I guess people are getting caught a little short there.
Completely. And what's impressive about this move after hours and part is heading into this, as we were talking about, this stock was already a monster. Yeah. It was already up 20% so far this year. It was already up about 140% over the 12 months. They also did make an acquisition here. They're going to acquire Flow Security, they say, kind of looking to expand their footprint in cloud security. Doesn't look like we have financial terms of that deal, but that's an interesting acquisition. Yes. And we are going to be talking to an analyst about this report, where the stock heads next, so looking forward to that. On the other side of the break, we are breaking down a busy week of U.S. politics with PIMCO's head of U.S. public policy. That's coming up next. Well, Box reporting, and it looks like we're kind of battling here in the after hours. Look at what we're going to be doing here. We're down now. It looks like we're kind of battling back to flatline up. Let's get some of the numbers. EPS beats. That was 42 cents versus 39 cents. Revenue was basically in line at 262.9 million. Looking ahead, Q1 EPS, they're calling for 35 to 36 cents. Estimate was 38 cents, so a miss there. Q1 revenue, 261 to 263 is what they're calling for. Street was at 261.4 million, Julie.
Yeah, and the stock is, even though it's up year to date, it's down about 4% over the past year. And analysts are not super enthusiastic. I mean, we've got, about 69% of the analysts who cover it rated a buy. That's 9. About 23% hold, and we got 1 sell on the stock as well. So, we'll see if they keep the momentum going from this earnings report.
Heading into this one, it was up about 10% so far this year. It was basically flat, though, over the last 12 months. But it looks like, at least initially, we're kind of bouncing all around. We'll see what shakes out. Sometimes the conference call helps give a little more confidence or less confidence, as we know.
We'll see.
Moving on, a big week in politics. Today is Super Tuesday, and President Biden has given his State of the Union address on Thursday. Our next guest is expecting a range of topics to be front and center. Here to help us sift through all of this is PIMCO's head of U.S. Public Policy, Libby Cantrell. Libby, it is great to see you. And maybe we'll get right to Super Tuesday, Libby. Listen, I mean, obviously, neither Biden nor Trump have really been sweating their rivals here, but I'm interested to get your take. What are you looking for? Are there interesting sort of trends and themes you'll be on the lookout for, Libby?
Yeah, well, good afternoon. I think for one, on the presidential side, this is going to effectively confirm what we already know, which is this is a coronation of both Biden and of Trump. About 30% of delegates are at stake today on the Democratic side, and 36% are at stake on the Republican side, and both eventual nominees will likely do very well today. So again, just really an affirmation of what we've really known for a while, and what we've been telling our clients is that this effectively is not a competition. It is a coronation of these two effectively incumbent folks. And that will obviously just position us for a Trump versus Biden election in, come November. I do think, though, that there are some interesting, races that are a little bit maybe more nuanced, but also actually should matter to the markets. These are for down ballot races, particularly in the House. The House is likely going to be competitive for Democrats going into November. And of course, the composition of Congress, we would argue, is almost just as important as who's in the White House, particularly as it relates to fiscal policy, spending and tax cuts and what have you. So things that the markets care about. So I'm here in California at our headquarters. There's some races, down ballot primaries here in California that could again be key to November. But for the things that people are actually really paying attention to, which is the presidential primary, again, effectively just a coronation tonight.
I do want to talk more about Congress in a minute, Libby, but first, it might be a coronation, but then the real competition begins, right, between the two presidential contenders. And the polling data recently has really caught our attention here because especially the way that President Biden is being graded on his handling of the economy. I know, for example, our political columnist, Rick Newman, has been sort of shocked by the numbers because by his estimation, Biden's done pretty well. What do you think accounts for that disconnect?
Yeah, and I think we would agree with Rick. When you look at all of these sort of economic metrics on paper, things look very good. Obviously, economic growth has been incredibly resilient. Labor force participation has been very high. Unemployment has been very low. Inflation has been softening. And an important but here is that if you look at the price level from when President Biden was inaugurated of January in 2021 to now, things like eggs, things like groceries, a gallon of milk. These have all increased a lot, in some cases by about 30% since he was inaugurated. And we really do think this in some ways explains why he is getting such low marks on the economy. Inflation, as we all know, effectively functions as a regressive tax. And folks have felt that. These are sort of become kitchen table issues. And again, they're scoring the president and giving him low marks on this. I do think that maybe some optimistic news for the president, though, is that some of those polls around his handling of the economy are improving ever so slightly. And so if that trend does continue as we get into the election, that could obviously be better for him. But I think it's hard to disagree that his polls as of now are not where they want where the Biden campaign wants them to be. We would just caveat, though, it is still very early. We're engaged. Some folks in the markets are engaged in this, but a lot of people are not paying attention to the 2024 election quite yet.
Libby, well, here's something that President Biden hopes he'll pay attention to was his State of the Union address. That's this week as well. Libby, what do you think his priorities are going to be there? What do you think the president is going to emphasize? And does it actually matter, Libby? I mean, do a lot of Americans still pay attention and tune in for the State of the Union?
Just by the numbers, not really. It was sort of in the 20 millions marks last year. That compares to 120 million people viewing the Super Bowl. One of our traders joked that we should get Taylor Swift to pop up at the State of the Union because that would drive viewership. But I do think that, sort of kidding aside, this is an opportunity for the president to have sort of the singular focus of 20 million plus Americans who are likely pretty engaged if they're staying home on a Thursday night to watch the State of the Union, and to really sort of tell his narrative, to talk about the accomplishments of his administration, the things that they are proud of. You saw that they just finalized this credit card fee, the limiting of the credit card fees today. I'm sure he'll talk about that. I'm sure he'll talk about the junk fees that they've been trying to sort of work on. So this is sort of his opportunity to give a pitch to the American people and effectively to kind of kick off his campaign. But again, it will depend on what the viewership is. And, Taylor Swift probably is not going to be showing up to the State of the Union.
We actually, believe it or not, we talked about that at our meeting this morning, Libby. So when in conversations with clients right now, given all the noise out there, given that it's still early, what are you telling clients is the single most important thing to watch, whether it's an issue, whether it's a candidate or a particular race?
Yeah, I would just say that our clients are already jumping to what a victory for sort of what a Trump 2.0 would look like, what a Biden 2.0 would look like. Again, we would say it's kind of early at this point. Just to the point that I made earlier, we do just emphasize that the composition of Congress really will matter. The Senate, the Democrats control the Senate right now by one vote. Looks very difficult for them to keep the Senate, just given the bad map that they have. The House, however, that the Democrats are hoping they can flip that from Republican control to Democratic control. So some of these dynamics that are on the congressional level, while, again, people aren't really paying attention to, actually really will matter in terms of what the next president can or cannot do. But in terms of sort of things to look out for, some of these economic indicators, does inflation continue to come down? Does the price of food and rent particularly, does that start softening? Because we do think that could be sort of a tailwind. What happens to gas prices? And then importantly, is there a credible third party that emerges? Because we do think this could actually be more of a threat to President Biden than to President Trump, particularly if a party calls No Labels. They are thinking about making a run. They could be on the ballots in many states, and that again could pose a threat to President Biden. But overall, it is still very early, even though it doesn't feel very early, because we now know it already feels like we're months into this general election, even though we really are not. So we would just caution people from extrapolating too much from a single poll or from a single indicator at this point.
We'll try to do our best. Libby, thanks so much. It was great to see you. Libby Cantrell of PIMCO, appreciate it.
Thanks so much.
Well, shares of cybersecurity firm CrowdStrike are soaring after earnings. With more on the numbers, let's bring in Rob Owens, Piper Sandler co-head of technology research. Rob, from where we sit, the numbers look like they beat across the board, both looking at last quarter and looking at the forecasts here. It was interesting to see the shares fall in today's regular trading ahead of this. Was there sort of some caution going into these numbers and then they came out and beat here?
Look, I think we've had a pretty robust start to the year for tech and especially for cyber. And as we look at some of the other results, I think it's caused speculation just around what the health of the environment currently looks like. And so the sell-off into earnings was not surprising, but this is a very strong result. As you pointed out, we got about a 40 million beat relative to ARR, a beat on revenue and free cash flow, and it looks to be a strong guide as well.
And Rob, we got some acquisition news too. There's a headline here: CrowdStrike's going to acquire Flow Security. It looks like to expand their footprint in cloud security. Doesn't look like we have terms here, but just strategically, Rob, this move makes sense to you.
Yeah, it does. You know, CrowdStrike has been pursuing a lot of adjacent angles, Josh, and I think that as we look at data security posture management, or the larger play around data, given Crowd's footprint and given the opportunity to really drive a platform-like sale, you know, we think this is the type of acquisition that makes sense, given their presence in the market and the adjacencies that they're moving into. And it's something they've actually foreshadowed before, to start to talk about their data protection capabilities.
Rob, now that we have had CrowdStrike, we heard from Palo Alto, what do we know about, you know, enterprise spending here, and in particular their willingness to spend on this area?
Look, we see indefatigable cyber momentum right now, and I think that there was speculation to the contrary a couple of weeks ago on that Palo Alto call. But I think the reality is that large corporations are dealing with a lot of things right now. You know, whether it is increases in attacks, ransomware, increases in regulation and disclosure requirements, bringing AI into the mix as well. And I think at the end of the day, fundamentally, this space sets up as well as I've seen in the past couple of decades.
Wow. And looking ahead, Rob, you know, we think about the upcoming election. Is that a potential catalyst for a name like CrowdStrike?
You know, I think it's a potential catalyst for the space, Josh. I think it's a good question. You know, obviously, there's speculation from a partisan perspective as to one side being more tech-friendly than the other. But you know, at the end of the day, we're seeing a lot of nation-state activity. And even the head of the FBI came out recently and predicted some type of Pearl Harbor-like activity that may happen to our critical infrastructure within the next 6 to 9 months. I think cyber is going to be top of mind, you know, whether that is attacks on digital infrastructures or whether that's attacks on physical infrastructures as they become integrated with IT. So at the end of the day, I think that, you know, election season is going to continue to point to a lot of deep fakes, a lot of phishing attempts as well, and the potential for increased attacks.
And I'm looking at some of your ratings on cybersecurity broadly. It looks like you're overweight on most of the space. Is there a company that you think is best poised here? Is it a CrowdStrike, or is it perhaps one of its competitors?
You know, as we've looked at our top 5 ratings, you know, 2 are a little more in the infrastructure, but frankly have backdoor cyber plays in Datadog and GitLab. And as we look across that cyber infrastructure, it's been Zscaler, it's been CyberArk and CrowdStrike that have kind of rounded out the top 5. So we continue to think that the fundamental landscape remains very healthy, and we continue to think that these companies can outperform expectations as we move throughout 2024.
All right, we should mention, by the way, CrowdStrike CEO George Kurtz is going to be joining Yahoo Finance on Thursday to break down all these results. And Rob Owens, thank you, as always, for joining the show, Rob. Appreciate the time.
Thank you. Good to see you guys.
Time now for What to Watch Wednesday, March 6th. Starting off with the Fed. Fed Chair Jerome Powell kicking off 2 days of congressional testimony. Tomorrow, starting with the House, Wall Street will be listening closely as Powell will likely cover a host of topics like inflation, rate cuts, and monetary policy during an election year. We're also going to get another round of commentary from Fed Presidents Mary Daly and Neil Kashkari later in the afternoon.
And moving on to the earnings front, Campbell Soup, Abercrombie & Fitch, Foot Locker, and Victoria's Secret all report tomorrow. Victoria's Secret announcing fourth quarter earnings after the bell. The retailer turning things around over the last 6 months. It's up more than 30%.
And moving closer to the economy, the Fed releasing its second beige book of the year tomorrow. This newest report will give us more insight on the state of the consumer after January's book showing signs of them pushing back against higher prices. Julie, what's on your radar tomorrow?
Same thing that's on your radar, I think.
You think so?
We're both talking about Jay Powell and his testimony before Congress. I mean, it's an interesting moment for Jay Powell because, you know, we've been talking a lot about the presidential election. He would likely get a lot of questions from members of Congress about whether the Fed is politically motivated. There has been a lot of talk about the timing of rate cuts. versus the timing of the election. How is it going to affect things? I suspect that's going to be a big topic of conversation.
Yeah. Well, if you're looking for a soundbite and you were a politician,
They never do that.
That would be a really good way to go. I think you're right. I think it's true. We haven't heard from him in a while. We got a lot of economic data since we last heard from him. It's always worthwhile. I think you're right. He gets grilled about the economy, inflation rates. I don't really expect him rocking the ship here. I don't expect him to kind of change the narrative. I think we'll hear a lot of economy sturdy. Inflation moving in the right direction, not where I want it yet.
Right. I think he's going to get grilled on it not being there yet as well.
And how long
many of those members of Congress are hearing from their constituents about higher prices, I would imagine.
I think we hear a lot of patience, caution, moving slowly, right direction. Yes.
He's that kind of a guy.
Yeah.
All right, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. And stay tuned. We've got more Yahoo Finance on the other side.
Signs of strength in the cybersecurity space. CrowdStrike reporting strong fourth quarter results and guidance came in above expectations. Joining us now is Lane Best, Deep Instinct CEO, also former CEO of Palo Alto Networks and former COO of Zscaler. Lane, it's good to see you.
Thank you for having us.
So we were talking off camera, Lane, about this, how CrowdStrike just reported. Obviously, investors really like what they heard. We also, though, recently heard from Palo Alto Networks. Now, there, investors were disappointed. We heard the company kind of talking about fatigue, right, among some customers. How do we square this? How do we look at these reports? What are the themes we should take away here?
Yeah, well, I'll say you had Rob Owens on just before me, and the trend that he alluded to in terms of strength in the cyber tech sector will continue. It's really a question of where the customers need help. And what Nikesh referred to is that there's been so much money spent and they still have challenges. And for example, I'll go to a dinner after this with 20 cyber executives, and I'll ask them the question, okay, how many of you feel that you're well protected? And they'll raise their hands. How many of you think that your threats can be prevented? And the answer is no. So the fatigue is coming with all the money that's been spent. CrowdStrike, great company, wonderful results, but they detect and remediate. They don't predict and prevent. And that's really what got me off my bench again to do another company. The AI generative threat is going to raise the bar, and these fatigued buyers are going to need more than companies that are just simply acquiring broader sets of security solutions to strengthen their wallet share with these customers. They need prevention.
So just to put a fine point on this, what most of the big cybersecurity companies do now is they deal with the threats when they come.
That's right. And
rather than stopping them before they get in the door.
They don't have the AI capability. Not all machine learning is the same, and everybody will talk about their machine learning, but there's a technology called deep learning, and that's why we call ourselves Deep Instinct. And this is a level above. It really is the most sophisticated segment of AI there is. And unless you really have this built into your platform, you're really going to essentially be addressing threats already hitting your hard disk. You talk about data protection. Many companies are already infected and they don't know it.
Now, a layperson, I've always heard, right, while the cops are getting smarter, in your case, the attackers are also getting smarter.
That's right.
So how do you keep up
That's
with
right.
that?
And that's a very good question. As I say, you can't fight fire of a house fire with a garden hose. The AI that's being developed now, using generative AI for attacks, is very hard to get away. It's not just deep fakes where people are imitating somebody's voice. It's very creative ways to get around a lot of the security that customers are fatigued in buying. So you have to have a more sophisticated AI to fight it. Our engineering teams at Deep Instinct are amongst the smartest that have been on both the defensive and attack, and have developed a platform that essentially can predict and prevent. And all of these companies, Zscaler, Palo Alto Networks, CrowdStrike, that are playing very well with this momentum, and the momentum that will continue, are going to need to, beyond just broadening their platforms, they're going to have to go deep, no pun intended, but deep into the AI to actually prevent. That is what customers need and want.
I'm interested, who poses, in your opinion, sort of the greatest cybersecurity risk at this point? I mean, are we talking about rogue states, criminals, both?
It is both, but it's an election year, so we're going to see probably a lot in the nation-state attack type of things. And it's, people are going to use that as an excuse for perhaps election results, but the nation-state attacks are going to continue. But let's face it, the simple generative AI tools that are available today, LLM models, can help even moderately sophisticated bad guys, bad actors, profiteers to launch and relaunch ransomware attacks.
I'm going to ask that question even more specifically when it comes to our presidential election here in this country. We know that Russia has been involved in past elections, trying to influence things through social media, certainly China.
Yes.
Will they succeed? Do you think that they actually have influenced past presidential elections, and is there a high chance that they will again?
Yeah, well, I'm not necessarily going to make a political commentary. I don't think results were impacted, and I'll state that pretty well. The attacks are taking place. I will say that our federal government has invested in some of the people we recruit are people who've had great careers in terms of prevention in federal government. So I actually think our federal government is very well prepared.
I don't mean the actual voting results. I mean how people vote in influencing psychology.
Yes, yes. Look, at the end of the day, I think there will always be attacks in cyber. This is going to be what I believe to be one of the next frontiers of warfare. I believe this is a time, and I'm excited about the AI opportunities in cyber. We talk about where the opportunities will be in cyber. They will be in AI. We can talk about other places where there's AI opportunity. cyber is going to be the place that's most needed, and I'm very encouraged by what I see in terms of the early ability for us to outmaneuver the bad actors.
All right, let's hope. Lane, thank you so much for joining us today.
My pleasure.
Really
Thank you very much
appreciate it.
for having us.
And coming up, weather warmer means more time outside. We're talking with the CEO of composite deck manufacturer Trex about outdoor renovation demand. That's coming up next. The markets may not have rallied today in the way we have seen recently, but listen, that's not stopping strategists from using the dreaded B word, bubble. As the AI rally storms on, buoyed by NVIDIA reaching record highs again yesterday, it has the street questioning when we may see a pop. Our very own Josh Schaefer has been looking into this, and it seems if history tells us anything, we may have a little more time, Joshua.
Yeah, Josh, I was polling some strategists on the street and simply asking that question. Are we in a stock market bubble? Are we in an AI bubble? And if so, what would it look like? And essentially, a lot of the charts they're looking at show us that history tells us, at least for now, we're not in a bubble. There's one basic chart that DataTrack first highlighted last week, and several strategists have highlighted since. You're looking at the S&P 500 3-year returns. So the 3-year return for the S&P 500 right now is about 30%. You can see in 2000, it was about over 90%. You saw a similar pop in about 2012. You also saw a pop in that meme stock rally in 2021. We're not seeing that to this point, so when you zoom out and you remember 2022 when the drawdown we had. We're not talking about a bubble exactly. Another thing that was highlighted to me from the team over at Goldman Sachs that was quite interesting is when you take a look at what stocks are participating in this rally. So you've got two lines here. You're looking at the share of US equity market cap companies. That's companies contributing to the overall market cap. You notice that's lower than 2021, and that's lower than what we saw in 2000. The other key takeaway here, and Ben Snyder over at Goldman Sachs pointed this one out to me, when you look at that light blue line, there's not a lot of companies that are highly valued. So this is looking at highly valued companies participating in this rally. There's not a lot of companies. We talk about all these companies and we point at these big stock moves every day. Look at this company up 20%, look at that company up 20%. But when you zoom out, they looked at over 3,500 stocks in that chart we just showed. Less than 20% of them are considered overvalued right now. So kind of the key takeaway there being it's not what we saw in 2021, sort of a pure euphoria rally. A final chart I want to look at here is just taking a look at debt. When we talk about margin debt and how that is impacted in the markets here, normally you would see investors trading on debt when we're in a big bubble. You can see the purple line and the blue line come close together in the dot-com bubble. They come close together in the 2021 bubble. Interesting right now, they're not that close. So
in other words, people are not borrowing to buy stocks.
They're not borrowing to buy stocks, which would be a concern, right, Julie, because then people could get over-levered and that would unwind very quickly if we were in a bubble. So those were some of the key takeaways I've found from talking to some folks.
Yeah, and Nancy Tengler, when we spoke to her earlier, she also said, if you go back to the 1990s, for example, and you look at a stock like Cisco that was trading at 100 times earnings, you're not seeing those sort of eye-popping valuations right now, to your earlier point about valuations. Josh, thanks, appreciate it. Well, near 7% mortgage rates are pushing many Americans to forego moving. Instead, folks are staying put and they're upgrading their current spaces. Trex, a composite decking manufacturer, sees robust consumer demand over the next few months in the run-up to warmer weather months. With more, we're joined by Trex CEO Brian Fairbanks. Brian, it's good to see you. Thanks for being here.
Great to be back again. Thanks.
This is something we've talked a little bit about, all track to in terms of housing sales or people not moving but building out their spaces. So kind of where are we in that outdoor space beautification cycle, I guess?
Yeah, our business is 90 to 95% repair and remodel. It's not that tied to the new home cycle side of things. While it's important from an overall economic metric perspective, we do follow it from that perspective, but it doesn't necessarily drive the deck purchase. What we are seeing, because there is less move up right now, is people are staying in their homes for longer. They tend to already have the home, have a low mortgage rate on that home, and have a desire to improve on what they already have instead of moving into that more expensive home. So we've seen that as a nice tailwind over the past couple of years and expect to see that continue in 24.
Does that tailwind, though, Brian, does it become a headwind? I mean, to the point when the 30-year fix does actually drop and housing market has some steam to it, how does that then impact the business?
Yeah, interestingly, when the consumer moves back to that move-up cycle, what we see is people improving that move-up home along the way. So what I was worried about is without people moving up, we would actually see a headwind. Instead, what we saw was a continuing tailwind. So it's really kind of the Goldilocks situation. Either way, we do fine in that marketplace. So we're fine with home builds continuing to pick up from here going forward, which I expect it will due to the shortage of homes. But until then, we're fine with the way things sit.
I'm also curious about whether people borrow for deck projects. In other words, are they taking out a home equity line? And is that then affected by what we've been seeing with interest rates?
It's relatively rare. What we find is less than 10% of our customers are using those home equity lines or other forms of debt to pay for that deck. It's a relatively low-cost repair and remodel project. You're looking anywhere between $15,000 to, let's say, $35,000 for a deck install. You'll be adding between 300 and, say, 600 square foot to your living space of the home. So it tends to be within the realm of the savings that our customers have, and most of it's done on a cash basis.
And Brian, when you see demand right now, kind of across the country, is it pretty even, or do you see pretty big differences regionally?
We are a very seasonal company. So in the wintertime, you've got less decks being built in the Northeast and Midwest, so you see more volume going to the southern states. But the season really turns on in mid-April and then runs through pretty much the end of October. We're building inventory in the channel, preparing for that seasonal surge that we're coming into, and then we expect it will be balanced at that point, as we saw last year.
The other thing I'm curious about is price sensitivity, and this is something we've talked about before. At a time when there's inflation in a lot of areas, are you seeing that people don't have the same willingness to pay the premium price that a Trex deck would cost?
The way we've been able to address that, and we understood going into times of economic uncertainty, there may be that desire for trade down. We have products at each level within our product lineup. We go anywhere from the wood conversion market, which is about 2 times the price of wood, all the way up to our premium products, which can be 5, 6 times the price of wood. So we've got products for any level that you want. But at the high end specifically, we've launched a couple high-end products in the last year. And you might say, why would you do that when there's economic uncertainty? We wanted to have that opportunity that if the consumer were going to trade down, they're trading down to another premium product. So for example, our signature product, the highest end product that we have, and they decide, maybe I'll just go one lower. So you move into our Transcend Lineage or regular Transcend product line, rather than stepping down to some of the entry-level deck boards. And it's been very effective for us.
So different price points, Brian. I'm just interested, is there a typical Trex consumer? Is there a typical kind of demo for you all?
Tends to be a homeowner, a higher family income on average, generally out in the suburbs. So the folks here in New York City aren't our average customers, but of course, everybody out in the suburbs of this area are our customers.
And those different price points you mentioned, are you seeing strong demand across the different price points?
We are, absolutely. With the launch of those higher end products, it really helped keep that portfolio at the high end. But we also respect there's a large wood conversion market out there. And that wood conversion will start generally at the lower end. Those products generate good profits for us, so we're happy to bring people in and then try to move them up the spectrum. So our Enhanced Basics sells at 2 times wood. Research showed us that's what it takes to open the discussion. Once you open the discussion, we can move them up the product line.
All right. Brian, thanks so much for joining us today. Really appreciate it.
Great to be here. Thank you.
And coming up, Disney CEO Bob Iger speaking today regarding his proxy battle with Nelson Peltz. We're going to dive into the latest on the other side.
2024 is really a critical year. This is a year of execution.
Culture eats strategy for lunch, but I think you need to have a strategy for culture. The culture that we have at Under Armour is one of grit, of determination, of belief.
OMSOM is all about being proud and loud. OMSOM is our true energy and ethos and spirit.
Our vision is to create a world with 0 crashes, 0 emissions, and 0 congestion.
And I'm excited to show the world what we can do.
Disney CEO Bob Iger is looking to keep his focus on turning around the business, even with activist investor pressure hanging overhead. Yahoo Finance's senior reporter Alexandra Canal here with the very latest.
Yeah, so this is a Morgan Stanley Media and Telecom Conference out in San Francisco. We've heard from a fair amount of media executives, but everyone was excited to see what Disney CEO Bob Iger would have to say here, because Disney has been in the news a lot lately, especially as it relates to these activist fights. Bob Iger, not mincing words, saying he does not want this to distract from the core of the business. He said, quote, "I'm working really hard to not let this distract me, because when I get distracted, everyone else gets distracted. That diverts the focus of the company, and we really need to be focused in order to deliver shareholder value." He pointed to the complexities of Disney's business overall. You have multifaceted segments. You have a lot of those segments undergoing severe pressure, like streaming. He said it's not only a business that takes a significant amount of knowledge, but it also takes a significant amount of focus. So he's really just concentrated on the issues at this company, and there are quite a few right now. We have studio output not performing as well as expected. We have a slowing parks business. The stock has recovered from those multi-year lows since Nelson Peltz first launched that proxy fight, but there are still a lot of overhanging issues that shareholders have questions with, and the proxy battle is certainly a distraction not only for Iger, but I also think a distraction on the part of shareholders as well when they're trying to parse through this company and really what the future holds moving forward.
Yeah, and one of the other things that he addressed during the conference is something that even a Marvel fan like myself, has experienced, which is Marvel fatigue, right?
Yes.
That there's just so much content out there.
Yeah, and he's admitted that there has been an overproduction of content, and this stems back from when Disney Plus first debuted. They really wanted to pump out as much content as possible, create a lot of Marvel shows, create a lot of Star Wars shows, and then it led to this Marvel fatigue. But he did press back against that, saying that he doesn't think consumers have fatigue when it comes to certain really good shows. That's what he said. He said, if a movie is good, if a show is good, people will come out and see it.
Right, but not everything has been equally good.
Exactly, and I think that's his point. There's been a missing link here. There's lack of creativity. That's the word he's continuously used. And he even said that they had to go back and scrap certain movies and projects. He said they haven't been public about that, but that they've really been trying to parse through their catalog of content and make sure that they're not just releasing movies and TV shows just for the sake of releasing movies and TV shows. So we'll see. They do have a significant slate coming out in the back half of this year. We have the Moana sequel. We have Kingdom of Planet of the Apes coming out as well.
Yeah, it's all sequels.
And again, it's all sequels. It's all franchises. But analysts have also said that's sort of what the company needs.
I mean, listen, I'm going to watch the Moana sequel. Don't get me wrong.
I think everyone will. Hopefully the music's as good as the first.
Yeah, we'll get a little rock.
Exactly. He's
singing.
coming back.
Excellent. Thanks, Allie. Appreciate it. All right, let's take a look at what's trending after hours, starting with shares of Nordstrom. The stock is falling as the company's full-year guidance fell below analysts' expectations. Nordstrom saying it expects adjusted earnings to come in as low as $1.65. The consensus was $1.98. And during the quarter, credit card revenue grew at a slower pace than the street was looking for during the fourth quarter. Still, the retailer managed to beat on both the top and bottom lines. And moving on to Ross Stores, the company reporting a beat on earnings per share for the fourth quarter. Comparable sales grew 7% as its operating margin rose nearly 11% compared to the prior year. Meanwhile, the company's full-year guidance on both earnings and same-store sales came in below Wall Street expectations. And that does it for us on today's Yahoo Finance Live. Be sure to come back.
Very dramatic pause.
Well, I thought I didn't know if there were any more movers in there. I wasn't sure.
You never know.
All right, come back tomorrow, guys, at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.